As you can see on the slide, we'll focus on the capital budgeting paradox and navigating the NPV versus IRR conflict.
All right, if you're grinding for that CFA Level 1 exam, you absolutely need to know this. We're going to walk through one of the most common capital budgeting traps you are pretty much guaranteed to face, the big conflict between NPV and IRR.
It's a classic scenario, isn't it? It's designed to really test your fundamental understanding. Your net present value calculation is telling you to pick one project, but the internal rate of return is pointing you to the other one. So, which one do you trust? Let's dive in and figure it out. To make this all feel a bit more real, let's follow the story of Rahul, a CFA Level 1 candidate who runs into this exact problem while he's studying.
So Rahul's got a choice to make. He can only pick one, either Project A or Project B. And that little phrase, mutually exclusive, yeah, that's a super crucial detail for everything that's about to happen next.
Okay, so take a look at these numbers. What's wild is how similar they look at first glance, right? Same investment, same project life, same discount rate, but the key difference, the thing you got to notice, is the cash flow pattern. Project A is just steady, $50,000 each year, but Project B is, backloaded with a huge payoff at the very end. As we're about to see, this difference in timing is the exact reason this conflict happens.
So, Rahul, being the good CFA candidate he is, knows exactly where to start his analysis, with the two big tools for evaluating any project.
On one side, you've got net present value, or NPV. This tells you the absolute concrete dollar amount, or in this case rupee amount, a project will add to the company's value. On the other side, you've got the internal rate of return, or IRR, which gives you a percentage. It tells you how efficiently that project is generating returns.
Now, the rule for NPV, it's honestly beautiful in its simplicity. If the number is positive, if it's greater than 0, it means the project is expected to create more value than it costs. You accept it. Easy. And the IRR rule is just as straightforward, at least on the surface. If the project's percentage return is higher than your required rate, which is 10% here, you accept. So based on these simple rules, both projects are probably going to look pretty good. The real trick, though, is when you can only choose one of them.
And this, my friends, is where we hit that classic exam trap. When you have two perfectly acceptable projects, but you can only pick one, you have to rank them. And that is where things can get complicated. So Rahul fires up his calculator, he plugs in all the numbers from our table, and boom, the results have him staring at a classic CFA dilemma.
And check this out. This slide lays out the problem perfectly. The NPV for Project B is higher, coming in at around 27,000 rupees. But wait a minute, the IRR for Project A is higher at roughly 23%. The two metrics are giving him completely opposite advice.
So yeah, this is that moment of confusion. The big question is, what do you do now? Do you go for the project that adds more actual money to the firm's value, or do you pick the one with a higher percentage rate of return? Well, thankfully, the CFA curriculum has your back. It gives you a crystal clear, non-negotiable rule for this exact situation. There is a right answer, and knowing it is what separates the prepared candidates from everyone else. And here it is, the golden rule. You ready? When you are facing this exact conflict for mutually exclusive projects, you always, and I mean always, trust the net present value. NPV is king. End of story. And just like that, Rahul has his answer. He should select Project B, the one with the higher NPV of about 27,000 rupees. But okay, why? Why is NPV the boss here? Well, it all comes down to one key idea, the reinvestment rate assumption. See, NPV assumes that the cash you get each year can be reinvested at the company's discount rate, a reasonable, realistic number. IRR, on the other hand, makes this really optimistic assumption that you can reinvest those cash flows at the project's own super high IRR. I mean, think about it. Is it really likely you're going to find another project with an equally high 23% return? Probably not. Because NPV uses a more practical, real-world assumption, it gives a much more accurate picture of how much wealth you're actually creating for shareholders. Okay, let's boil all of this down into a super simple cheat sheet you can mentally pull up on exam day whenever you see an NPV versus IRR question. First things first, NPV is your most reliable method for ranking projects, period.
Second, keep your eyes peeled for this conflict anytime you see mutually exclusive projects with different cash flow timings, just like our steady Project A versus the backloaded Project B. And third, and this is the big one, when in doubt, trust NPV. It's the one that's directly tied to the main goal of finance, making the shareholders wealthier.
And that's the big aha moment for Rahul. This whole thing isn't just about crunching numbers or remembering a formula. It's about understanding what those numbers actually mean and how they should guide a real-world business decision. So there you have it. That rule, trust NPV, is a really powerful one, right? It kind of gets you thinking, what's the most valuable, most decisive financial rule you've ever picked up in your own studies or your career? Something to think about. Thanks for tuning in.